Hello, everyone, and welcome to the Capital Intelligence channel. Today, we are diving way beneath the surface of retail investing to unpack the actual institutional mechanics that drive the markets. If you're serious about finance, you already know the headlines rarely tell the whole story. So, we're going to focus on the absolute essentials you need to know to navigate today's super complex landscape and look at how the smart money truly operates when the pressure is on. To set the stakes for our explainer today, let's look at a recent warning from legendary investor Paul Tudor Jones. He pointed out that in our currently over-equitized economy, a market correction could cascade harder than ever before. He noted that the stock market is exceptionally high right now, meaning making money with a long-term view from this point is going to be incredibly difficult. So understanding the underlying mechanics of a market drop isn't just some academic theory, it's an absolute necessity for your survival and growth in this environment. We're going to break this all down using what we call the iceberg model. We'll start with navigating market volatility, then the truth about leverage, decoding price discovery, the liquidity mirage, and finally protecting your portfolio. Let's jump right in. All right, part one, navigating market volatility. Starting right at the surface, there's a simple fraction that tells a massive story about market psychology: 1/3. If you look at historical data since 1950, the S&P 500 has been in a drawdown of 10% or worse roughly a third of the time. Plus, 2/3 of all years experience a 10% peak-to-trough correction at some point. So, historically speaking, there are plenty of opportunities to buy the dip. It sounds like a great rules-based approach, right? Blood in the streets, you buy. But let's look at the actual reality of executing that strategy. Think about the dilemma of holding dry powder. Say, keeping 20% of your portfolio in fixed income bonds, just waiting for stocks to drop so you can pounce. The glaring issue here? Timing the market requires you to be right twice. You have to know exactly when to buy and exactly when to sell to get back into bonds. More importantly, historical droughts between these 10% corrections can last an agonizingly long time. Just look at 1990 to 1997. That was a full 7-year drought without a single correction. Honestly, could you sit patiently in bonds for 7 years while the rest of the market literally doubles? For most of us, the answer is no. This is exactly why picking a strict asset allocation and just occasionally rebalancing is a far more reliable, brain damage-free strategy than trying to time the market perfectly. Moving just below the surface, part two, the truth about leverage. Now, margin provides some incredible flexibility, letting you multiply your buying power by borrowing against your collateral. But while leverage totally magnifies your gains, it brings massive systemic danger because it magnifies your losses in the exact same way. Even a small adverse market movement can rapidly wipe out your initial investment, and sometimes even more. And that brings us to the actual mechanics of a margin call. Let's say the market moves against your leveraged position, causing your account balance to drop below the required margin requirement. Bam! Your broker issues a margin call, demanding you deposit additional funds immediately. If you haven't used proper risk management and you cannot meet that call, the broker automatically liquidates your position to protect themselves. This cascading, step-by-step liquidation process is exactly how volatile swings rapidly wipe out entire portfolios. It is literally the hidden undertow of the market iceberg. Which leads us to part three, decoding price discovery. So how do these volatile movements actually find their true value? Price discovery is essentially the continuous, real-time interplay of supply and demand. Every single time new data drops, whether we're talking about an earnings report from a tech giant, an interest rate change, macroeconomic reports, or a sudden geopolitical shock, the market digests it instantly. When demand outpaces supply, prices move higher, and vice versa. As a series investor, you absolutely have to realize that current market conditions always mirror the current behavioral patterns of investors reacting to these specific factors. Plunging into the deep end of the iceberg, we hit part four, the liquidity mirage. Michael Wynn, the global head of FX and liquidity for security services over at JP Morgan, recently advised treating liquidity like an operating system. Why? Because of what's called the liquidity mirage. This is a genuinely terrifying phenomenon where market depth looks incredibly plentiful on a normal day, but the absolute second a crisis hits, which is exactly when you need to exit a position, that liquidity completely vanishes. Poof, gone. Institutional players actually survive these noisy, volatile markets by rigorously managing their collateral and flows. They make sure to reduce idle cash but maintain ultimate resilience for when the market inevitably drops. They aren't just reacting, they're building robust systems to handle the drought. Finally, let's wrap up with part five, protecting your portfolio. So how do we actually take these high-value institutional insights and apply them to build a truly resilient portfolio? Well, here is your toolkit. First off, stop trying to guess the bottom. Just pick a strict asset allocation, like, say, 80% stocks and 20% bonds, and rebalance it occasionally. Let your fixed income naturally act as your dry powder, completely avoiding the brain damage of market timing. Second, if you are going to use leverage, absolutely mandate the use of stop-loss orders to prevent those catastrophic margin calls we talked about earlier. And finally, you have to critically evaluate any proven, back-tested trading strategy for survivorship bias. Survivorship bias is that classic trick of the trade, where a strategy looks artificially successful simply because it completely ignores the assets or funds that failed and dropped out of the market entirely. Don't fall for the mirage. Employ strict risk management. And that leaves us with one final, absolutely critical question to consider today. Is your portfolio prepared for the next liquidity drought? As you navigate this over-equitized market that Paul Tudor Jones warned us about, take a really hard look at your strategy. Ask yourself if your capital is genuinely structured to survive when the tide of liquidity inevitably rolls out. Thank you so much for joining me on this explainer today, and as always, keep building that capital intelligence.